Hey everybody, this is Brant. There's Ken. Ken's going to help me with Discord for the new website. Very graciously. Thank you, Ken. Good morning, everybody. Adam, Andrew, Reinhard. Reinhard, okay. Okay, so everybody, this was a touchy week for me with the market. Okay, so what I want to talk about was we came into the week with a market that was still in a bullish consolidation. And I am going to get my ugly mug off this and just go to TC 2000 here. Hopefully you can see TC 2000 coming up. There we go. Okay, so we have the S&P 500 here, and we have what is basically just a 7 to 10 year bond yield fund. That's IEF in blue. So what I want to show you was there, if you're a member, you're a subscriber to Wolf on Wall Street Trade, what I was talking about all week was this big kind of dichotomy or divergence between what the bond market represented in blue here was doing versus what the stock market or the S&P 500 in the red and green candlesticks was doing. This was a massive divergence. So if you recall last week, the idea was, this is a market waiting to break out, a lot of bullish price action, but it needs a catalyst. And ever since that payrolls report came in hot at the beginning of the month, we've seen this huge rise in Treasury yields. So over 50 basis points in the 10-year yield. So when you see the bond fund doing this, remember that yields move opposite the price of treasuries. Okay, so treasuries were going higher. So looking at this, if this were any time last year, because the markets had such a strong inverse correlation with yields, I think the S&P 500 would have been trading at like 3,900 down here, or about 4.5% lower. But we just saw this incredible resiliency, and we had basically three chances to get a catalyst that could break out the market to the upside. The first was the CPI reading on Tuesday, and that came in hotter than expected. So that doused. Hey, Arthur Crane, how are you? From Rome, all the way from Italy. So in any case, what I was saying was that the bond market was just doing the absolute opposite of the stock market. We had three really good chances for the stock market to get a catalyst to rally. The CPI on Tuesday came in hotter than expected. Normally, that would send the market lower. Then we had retail sales. That also just went the opposite way, went a bad way. And thirdly, we had the PPI report. All of them came in hotter than expected. So, seeing the bond market act like this, I'd expect the S&P to be down here around 3,900 and the way gold traded. But it was very, very resilient. So I want to just go to the stats on the week. So on the week, S&P's down 1/3%. I mean, that's like nothing, right? The NASDAQ is actually up 0.4%. Dow down 0.1%, and small caps up 1.5%. So it's pretty resilient price action. And you can see this bull flag. Let me just get rid of IEF here. And what I did on Friday, I'm going to show you the bull flag that we had last week, okay, because I changed it. This is the bull flag we had last week. That's the 4,100 level. That's kind of been like a line in the sand. But this is coming into this week. The market wants to break out. CPI, nope, not going to happen. Retail sales, nope, not going to happen. PPI, nope, not going to happen. But what's happening here is just another consolidation. So what I like to do is just take off the trend lines and then look at the market with fresh eyes. Because when you have the trend lines there, it just kind of, there's an inherent bias. So what I came up with and what I posted on Friday morning for members in my first market post was that I would expect the S&P 500 to find support at 40.50. The reason why was before the open, I had redrawn this flag, and we found support right at that 40.50 level at the trend line. And this is what I love. It tested and respected that trend line 3 times. And what's really crazy about these is if you get one of the trend lines, you could pretty much just copy it and put it, like, watch, I'll show you real quick. I'll just create parallel trend line, exactly parallel. And generally speaking, these bull flags are almost always symmetrically parallel. And look how it just respected price there. So really impressive action as far as that goes, with all that hot data and the real big divergence between stocks and bonds. I'll show that to you another way. Let me transition over to actually Stock Finder. So just give me 1 second, pull that up. Okay, cool. All right, so I'm going to transition over here to Stock Finder, and what I'm going to show you is high yield credit, which is one of my favorite leading indicators. So what you're looking at here is the S&P 500 in these red and green candlesticks, and the white line is high yield credit or junk credit, right? So it's very sensitive to moves in rates. You get a 50 basis point jump in the 10-year yield over 2 weeks, and it's going to come down like this. But it's also, if you have a more neutral environment in rates, it's one of the best windows into what institutional money's doing, because it's a really deep liquid product, and they often use it as a proxy for S&P futures. So oftentimes, if I could just choose one leading market signal, I would probably choose high yield credit, keeping in mind, how rates can affect it. But this is not a good signal right here, what we got this last week. So that is actually kind of a leading negative signal. And normally I would be turning a little bit more bearish here than I am at the moment. And I'll show you why as we kind of go along. The mega caps held up really well this week. So all last year, what were the stocks that were getting hammered every time yields rose 5 or 10 basis points? It would be the mega caps. And the mega cap index, like I would use like MGK for that, would usually be down like 100 basis points below the S&P 500 equal weight. So if the equal weight index was down 0.5%, the mega cap index would be down like 1.5%. Really haven't seen that happen at all over the last 2 weeks, with yields rising, except for a little bit Thursday afternoon and then Friday morning. But they held up really well. I think down 0.2%. And if I can transition over to TC 2000 again, I'll show you that they're sitting in a bull flag. So hopefully you can see this come up. So they're sitting in a bull flag too. I mean, it's not perfect, but it's a bull flag. A little sip from my fish sipping cup. So in any case, my point is, market has held up phenomenally well, given this this kind of more hawkish, hotter rates in January, which is what all the data is saying. But it's like anything, economic data is going to trend just like a market. You have something like this where you have a trend, and then you get noise along the way. So it's the same thing with economic data, but it was a pretty decent hot set of data coming in from January. In any case, let's move along here, and I want to show you. Well, I did show you the S&P 500 already and my redrawn trend lines. And what I want to say, though, is that I'm not as confident in the trend lines for like the NASDAQ 100. The reason why is, I just don't have, a test down here. So, and the same thing with like IWM. You can see that. Hey, Tony, how are you? Thanks for joining us. Go-Kart Mozart. I love that name. Cool. So anyway, not as confident in that. And the Dow has just been doing nothing. But this was my call a couple of months ago, because the Dow had led the entire rally off of the October lows. And let me back this chart out. I'll go to like a 2-hour chart here so you can see it. But the Dow was the first one right here, coming off this little double base, this double bottom or W bottom, to make a 20% gain. And the media started saying, oh, it's a new bull market and all that stuff. But I disagree with that. But in any case, it's been in this large symmetrical triangle. It does have a slightly bullish bias. A symmetrical triangle on its own has no inherent bias like an ascending triangle would or a bull flag. It depends on the preceding trend. But what I've noticed over the years is when they get real big like this, they can also act as tops. But again, the call was that the NASDAQ 100, which underperformed massively at the beginning of this rally, would take the reins of leadership and the Dow would start to underperform. So that's what we've seen. And otherwise, the Dow has pretty much held up in this triangle. Okay, I got a few notes, so I'm just kind of looking through these so I don't ramble too much. We got the bull flags and Dow. So let me show you what I told my subscribers this week. And we're going to look at the 10-year yield. Let me take these trend lines off. We don't need them. And get off this log chart. In any case, the 10-year yield, this is the break kind of inflation. And this big gap down here was the really first confirmation in CPI that we probably hit peak inflation, which doesn't mean inflation is low. But on a year-over-year rate of change basis, it was starting to roll over. So that's where we get this big gap. So what I told my subscribers earlier in the week was, we've got this basically about a 50 basis point jump over the last 2 weeks while the stock market's been consolidating in these bull flags. And I said, I think that if the stock market can hold in there for like another 10 basis points and let the 10-year yield test this 3.90 level, I think there's too much overhead supply up here for yields to continue to go much higher. And the yields going higher is what's put all the downside pressure on the market, which has held up remarkably well. So on Thursday night into Friday morning, this ran up to 3.92%. This is 3.9% right here, and then came right back down. So it did act as resistance, which suggests, sorry about that, to me, dry mouth, another sip here from my sippy cup, that we'll get a little window of opportunity for the stock market without all of the pressure of rising yields. Because I think at this point, 50 basis points over 2 weeks, I think they've kind of priced in that hotter data from January. In any case, that's something that's kind of interesting. And what really jumped out on my radar screen is I keep looking at Treasury futures and their 3C charts. I'm going to pull up some, and then I'm going to transition over to them. But what I've been seeing is 3C has just been confirming the downside in Treasury futures, which means yields going up and no expected change to that anytime soon. But we started to see a change of character that very night when the 10-year yield went up to 3.92% and then came back down. So I'm going to transition this chart to Thinkorswim. And what you're looking at is the, that's the 30-year Treasury future. And this is 3C. So this may not look like a lot, but it's the start of one of the first divergences I've seen in Treasuries over the last couple of weeks. So we have that in multiple tenors. So on this 2-minute time frame, I can see it on the 2-year Treasury future, which is the Fed sensitive. And you can see it right here, positively diverging into that overnight low or yield high. And we also have it on the 30-year. I think that's what I just showed, right? The 30-year. We have it on multiple time frames too. So the more tenors I see and the more time frames I see diverging, the higher the probabilities, in my opinion. So we'll go to a 3-minute chart here and look at the 10-year. So basically, these divergences, if it's something new, they'll start on the earliest time frames, like 1 minute, 2 minute, and as they build strength, they'll start to move to stronger time frames. So like this 3-minute time frame, which is again the 10-year yield. That's that overnight 3.92%, and we get this divergence. So that is a very powerful signal to me. It's one day, and one day is not a trend, but this is the first time in a while, in probably almost 2 weeks, over a week, that I've seen any divergence at all. 3C's just been tracking lower with prices confirming that. So even out here on the Ultra Bond, UB, again, positively diverging. And we even have some all the way out to 5-minute charts. That may not sound like a lot to you, but it's impressive to me because I look at these all the time. You can see a negative divergence here coming into all this hot data that we got during this week, and a positive divergence over here. So that was one big thing. We also see it in the 30-year, which is right here. I don't know why I keep getting this percentage thing. Drives me nuts. Maybe somebody could tell me how to fix this. Really not very skilled with TOS. For a technical guy, I'm not very technical, I swear. So the big thing, remember HYG, high yield credit, one of my favorite indicators, that has been leading the market lower. And that's been a main concern of mine. I've kept telling my members, because of the price action, I think we have about a 70% chance of a next leg up. But the thing that was weighing more and more and more on me was high yield credit and a few other indicators just not confirming. These are the ones that if they start confirming, I'll start moving that percentage from 70, 75 to 80 to like, yeah, this is slam dunk. 70% is still high in my opinion. But let me go to HYG. Let me set that chart up first, and then I'm going to transition it over. And this really, on Friday, blew me away. So I am going to transition to that. Here we go. Thank you. Okay, cool. May seem simplistic, but how do you perceive to see overhead supply, a critical point at this juncture of the markets? Arthur, are you talking about the overhead supply for the 10-year? Are we talking about the markets, the averages? I'll look back for the 10-year, Arthur. Let me go back to that 10-year real quick. So first of all, this massive gap right down here, this was basically the whole peak inflation narrative being born. And from that, you kind of get peak Fed hawkishness. And then the Fed, they haven't done a pivot, of course, but they've done a step down from 75 basis points to 50 to doing 25 now. And the market also survived like 4 or 5, maybe 6, like really hawkish Fed speakers this week that would normally just send it reeling lower, But yeah, this is just a major zone where everybody just got into bonds and dumped these yields. So this was a really critical juncture. Really the first time I think that CPI had confirmed 2 months in a row, and the whole peak inflation narrative was there. This, I think, again, is just a bounce. It's a noise in the trend. So I do just see this as a really critical level at 3.90%. But let me get back to that HYG chart. I'm going to transition over here. Actually, let me back it up a little bit so you can see how this worked in real time. Yeah, okay, this is going to be cool. I'm doing so much better with this live cast, I think, because I'm not talking for 10 minutes about a chart that you can't see. Okay, hopefully you can see HYG with 3C in orange. Okay, but is the supply stops in that overhead zone? Okay, but is the supply stops in that overhead zone? Like if you remember looking at that ZN chart, the 10-year Treasury, you could see when it hit that overnight low, there was a big divergence. So people were starting to buy those treasuries again. So I think they just recognized that zone as a really important zone. And it's like, if you're going to go through that, then you're going to kind of just say, well, January's data was so bad that maybe the peak inflation thing isn't still on, and we're getting resurgent inflation, which I really don't think is the case at all. But yeah, I think they'd really have to be convinced that it was more than just kind of like a blip in the road to go over that 3.90 level for the 10-year. So anyway, we're looking at HYG in a 3C chart, right? And I backed up the 3C chart. You can see this is the start of the whole consolidation in the stock market, the bull flags that we've been seeing. And what happened right over here, this was the payrolls report. So HYG, high yield credit, has been acting worse on a relative basis than the S&P 500. And you can see what 3C's been doing the whole time. It's been confirming lower. So if 3C is moving down with price, that tells me, it's a trend lower and nothing's changing. Don't expect anything to change. So the neat thing about 3C is that it has the power to contradict price, and it is a money flow indicator. It's one that I created like 10, 12, 15 years ago, based on time segmented volume from Don Warden, who was basically the inventor of money flow indicators like back in the 50s. But let me move this forward. So I think this is, what was that? The 15th was, I don't know, Wednesday, Thursday, something like that. I'm going to move this forward and I'm going to show you what started really jumping out at me Friday morning. This looks like the start of a divergence, right? This is what I would call a relative divergence, so you have a lower low in price and a higher low in 3C. Okay, keep an eye on it, but it's not jumping off the chart. Move forward a little bit, and then we come into, look, lower prices. 3C is moving higher, and here we are into Friday, right? Now, this is what started to blow me away. Look at this divergence. I mean, compared to the rest of this chart. And this is one of the things that has been bothering me the most about the market is these leading indicators that I watch were not confirming. They were going the other way. So the bond market was saying hawkish, which is bearish for stocks. And the stock market was bullish and holding up well. So you had this major divergence or dichotomy between the two asset classes. And quite frankly, bonds and high yield credit are usually right. So that was disturbing to me, but the fact price held up so well, you just couldn't ignore that. But now, after we see all these divergences in treasuries suggesting that yields may have topped out on Friday, again, one day's not a trend, but then we get this big divergence here in HYG2. I don't see a lot of divergences in HYG. It's kind of institutional money playground. But when I do see them, they mean something to me. So the next thing I would watch for is if this continues into the new week. And we already saw HYG start leading the S&P 500 intraday on Friday. It's been leading it lower. Friday, it started leading it higher. I could probably, this is not the way I usually do it, but I can pull it up here. So this is where I'm talking about it's been leading lower, and this has been, bothersome to me. Over here, it was leading lower, and then as price in December is just holding around this 3,800 area, look, higher lows, higher lows, higher lows, higher highs. It broke out before the S&P broke out of this little December range. So it's a very powerful leading indicator, and to see something like this is bothersome. But zooming in here on Friday, and this is a 1-minute chart, you can see HYG in white here starts leading the S&P higher. So I'm like, oh, finally, it looks like to me, we hit that 3.90% level. The equity market, I'm going to pull up S&P 500 again real quick, held up really well while I was doing that. And it looks to me like we could be getting set for a breakout and a next leg higher here. Let me put this on a log chart. And I'll show you real quick for the S&P 500. So nothing about what's happened in the last week or two has changed like the measured move. So for me, I would still take it from here. And that's about, 3.3% for the S&P. For the NASDAQ, it's more. I think the NASDAQ and small caps have the most potential, almost 6.5%. So you would count that 6.5% from where it breaks out above this bull flag. And for small caps, IWM, they're pretty similar, I think. Yeah, 6.5%. I prefer NASDAQ 100 right now just because of how well the mega caps and large cap tech are holding up. The fact that they've rotated in this year. They were last year's most hated stocks. They got just hammered. They got hammered right into the end of the year, right into December with tax loss selling. And suddenly there was like a change in character. And I always say changes in character precede changes in trends. So a good example of that would be to come back to this, sorry, stock finder chart. And this is a change in character, right? It's not a change in the price trend yet, but it's a change in character. So for me, this is why, I don't think there's any holy grails like indicators or technical trading systems that are holy grails. Now, I do agree 100% that there are trading systems and indicators that are best suited to you, and finding those is in really important part of your journey in becoming a profitable trader. But it doesn't mean it's the same for everybody. We all have like a different way we look at the market. We have different portfolios, different goals, different outcomes, different risk tolerances. So this is why, by the way, I'm getting off on a little rant, but this is why, by the way, I really don't like the idea of these sites that are like, we've got, the bomb trading system and everything, because I've seen it. I've done it and given the same trade to everybody, walked them through it, exactly what I was doing. And maybe, it was a 10% gain over 2 weeks or something. And you would have 10 different people that would have 10 different results. Somebody would make 12%, somebody would make 5%, somebody would lose 10%. The same exact trade, but we just all, it's like a fingerprint, or a snowflake. You're just unique. So finding what works for you is what is most important. So when people say, I have this trading system, it's like, that's great, but if somebody doesn't have the risk tolerance or doesn't have the time or the portfolio size to follow along and do exactly the same, then it doesn't matter. Anyway, point I was trying to make was changes in character or changes in tone lead to changes in trends. So I think that's pretty much all I've got here. I can mention one other thing real quick. What about okay, let me look at the comments, sorry. What about VIX and VVIX? Yeah, VIX is just, let me transition the chart again, just so I know that I'm not talking about something that you guys can't see. I'm going to pull up VIX real quick. Let me get rid of these trend lines and go to a daily chart. Okay, so VIX, that's a 200-day moving average. I'm taking off the dark blue, 100-day over here in light blue. VIX has just been really hung up since December at this 50-day moving average. If we call this a bear market rally, and some people don't agree with that, I'm seeing more and more people who are saying this is the start of a new bull market. And I'll show you why in a minute, but it's been an extremely, extremely low volatility area here, really, since December. But this is the time that the market's also been rallying. Actually, the market's been rallying since October. But as far as VIX, no unusual relative strength to speak of. Just keeps coming up here to the 50-day and getting rejected. I talk a lot about the absolute breadth index for subscribers that I use. And if we get, I can pull it up real quick, but it's not going to mean a lot to you just looking at this. But okay, absolute. There we go. We don't even need this moving average. This is a breadth index, but one thing I noticed about it years ago is that when it trades below 14, and I came up with the 14 level by doing a bunch of back tests and just seeing, what was the highest probability. So basically, the lower this goes, the higher the probability that you're going to see a big move in VIX. Sometimes as soon as the next day, but usually up to like a month after it triggers. So when you get a move below 14, I would say you have a 90+% chance that VIX is going to move at least 50% over the next month. And it could be as soon as the next day. We've had signals from this that sent VIX up over 450%. So when they come, and there haven't been a lot, which is kind of ironic, when the market was over here in 2021, we were getting a lot of these signals. Usually you only get maybe one or two a year. We got, I don't know, maybe a half dozen or more. And then the last time we've really got them was kind of last year, in the first quarter over here, just a couple, so we haven't seen anything like that. No big, strong signals in this indicator. We've come kind of close, but you got to get under that 14 level. So again, it was the first quarter of 2022, the last time we got some real big moves in that indicator. So let's see, looks like inverse head and shoulders. Are you talking about football story? Are you talking about this absolute breadth index? Or are you talking about the S&P? Because there are a lot of people talking about that. I'll pull up the S&P real quick. So yeah, a lot of people, I think Carter Worth, I don't watch CNBC very much, but I know he's on there from time to time doing charts, and he mostly just does like trend line stuff. Oh, VIX. So yeah, you really have to be, I mean, VIX will trend, but it's more of a sporadic kind of thing. It doesn't trend as well as like, stocks or commodities. So I usually don't look at VIX as like, I look at it almost more of an oscillator. There was a time when I first started trading in the late 90s that, if VIX went below, let's say like 20, the market was going to top out. And if the VIX went above 30, the market was going to bounce. I mean, it was like that, solid of a, yeah, I know those options. I know there's a lot of talk about those too. Zero DTE. In any case, yeah, so Carter Worth, I guess, came out with a chart saying, this is bearish. And then some other people pointed out, I saw this on Twitter actually, some other people pointed out, well, we have an inverse head and shoulders over here. I'm indifferent on this because, if you're a subscriber of mine, somewhere around September, I think, what my call was that we were going to work on a base, which we did in October, and then we're going to see the market move from a primary downtrend. And this is why I don't agree with people who said, hey, the Dow gained 20%, it's in a new bull market. Well, I'm looking at the primary trend, right? And it's not in a new bull market. It is impressive, but it's not in a new bull market making higher highs and higher lows. But what we do see is exactly what I was telling my subscribers that I would look for was a market transition from the primary downtrend or bear market to an intermediate lateral trend, which is what I'm calling like phase one of three phases that I think we're going to see in the market. And if you look at small caps, what do you see here? A lateral trend. This is exactly what I was calling for sometime, I think around September or so. But this was pretty much all I was calling for. I didn't really know which way it was going to go next. I still don't. But my suspicion is that we have three phases of the market. And the first one is, thank God the Fed is stopping or stepping down from rate hikes. So a relief rally, the thank God rally, phase one. And I think after that, it's phase two is the bill for fighting inflation, which has been raising rates and inverting yield curves all over the place, is going to come due. And phase two is a recession. And I think phase two will probably see the primary trend reassert itself down and be back in a primary trend bear market. And then at some point where nobody wants to own stocks and everybody hates it, everybody's bearish, we'll move into phase three, which is the bottom. But we're not even at phase two, the recession yet. I think we're kind of late phase one. Thank God the Fed is slowing down these rate hikes. Does anybody have any questions or observations you want to share? Okay, so Adam asked if we did meet, or if we did break out of, guys, let me turn on my webcam real quick. You see these? And I have my blue ones, right? Kind of funky cool. I have the dark blue ones. Tortoiseshell, yeah. I can't see anything anymore without glasses, so I was struggling to read your um, comment, but I'm going to get back to that. Get my mug off here. Okay, so Adam, if we did break out of these bull flags and met the measured moves, do you think we could still go higher? I guess I guess it's us and when and if we get there. So Adam, that's a great question, and I got to be honest with you. Towards the end of last week, let me make sure I have the right chart up. You should be looking at S&P. Yeah. So towards the end of last week, before Friday, my call was, guys, I think this might be the last leg up. Let me move over to this white screen. I like that better. I said, I think this might be the last leg up. So we had the cyclicals lead the first leg up off October's low. Coming to December, now we have the mega caps leading. So that's a healthy thing to rotate from sector to sector. And the money that's going into mega caps is largely coming out of the defensive sectors. So those would be like the bond proxies, consumer staples, utilities, healthcare to some degree, real estate to some degree. That's a positive thing. And the reason I said, hey, look, this might be the last kind of leg up is because of those leading indicators I was talking about, like HYG, not confirming, not even like doing the same thing, but leading lower. So if we get a change in that and these leading indicators start acting better, maybe yields come down, then I think there is a decent chance that we could add more. But yes, stop and reassess. So the most probable thing, I'll show you a quick, easy way, if you have it on the log chart, to get a measured move, is you could just draw it as long as you have a log chart on. So wherever it breaks out, so let's say it breaks out over here, this is basically our 3.5%, you get your measured move up to about 4280, right? Maybe 4300, but I would say 4280. They usually come in incredibly accurate. I mean, like to the percent, to the dollar, sometimes to the penny. And, this is no trick of like technical. I mean, what you're looking at, what price is representing is mass human psychology. So all these patterns, I had a blast like going back and looking at the Dow in 1915, 1920, 1929. You find out, where all of these great technicians that first identified these things got these patterns because they were everywhere back then. So since the Fed has been just squashing volatility with their monetary policy, injecting money, keeping rates low, you don't see them as often as you did back then. But it's a really neat thing to see. But my point is that the reason these work, and they work on multiple time frames, if you're on a 1 minute chart, if you're on a daily chart, and by the way, the average length of a bull flag on a daily chart is 3 weeks. So we're at about 2.5 weeks right now. The reason they work is because human psychology never changes. The same two things, the same two emotions that rule price, fear and greed, they don't change. That's why these price patterns, what they are is a depiction of human psychology. They don't change, and it's been incredibly reliable. So even like some of the, the systems that are trading, they're programmed by humans still. They're using the same inputs. But so my call would be that I would expect a consolidation. So yes, reassess and see if that consolidation starts to turn kind of bullish, or if it starts to look toppy, see what those leading indicators do, high yield credit, how bonds are acting. There's a lot of things that I watch, but that's pretty much the answer there. So let me take a look. Also, market breadth still strong. Let's take a look. Give me just a second to set it up and pull it in. Market breadth has been pretty darn amazing, to be quite honest with you. I am going to pull up just a real simple one. Let me transition so you can see what I'm talking about. And what you'll be looking at is black screen stock finder. So this is the S&P 500 in the candlesticks, and this white line is the percentage of NYSE stocks that are trading above their simple 200-day moving average. So if you've been with me for a while and you were here during the bull market back here in 2021, I was just pounding the table and saying, wow, breadth is completely falling apart. The reason why was it was basically the mega caps leading and no other stocks were participating. So we got this horrible, horrible breadth, which was making for a very fragile market. And you can almost see this kind of head and shoulders top here in the S&P. But if you look at what happened coming into the October low, positive divergence, right? Breadth getting better participation. You can see it right here. And over here, we're making higher highs than over here. So that's very positive. Over here, again, more higher highs, higher than at the height of the bull market over here. So yeah, breadth is rip roaring strong. I'm going to take a look at the comments here. As someone who has some 224 TBT puts at 29 and 28.50 worth 2 cents, I am wondering how quickly TBT could come down based on the current 3C indicators. Okay, so basically most of what I saw on those charts is in Treasury futures, which is a good start. And usually I do see them in Treasury futures first before the cash market. So what I would say, Dennis, is if you want, get together with me like the market's closed Monday, but Tuesday morning, and let's take a look at if these divergences in treasuries are holding up and what's happening with TLT and TBT, because it seems to me that, they've just been hammered and hammered and hammered over this hotter than expected inflation data the last 2 weeks since the payroll report. But it seems to me that this 3.90 level for the 10-year yield is just going to be a difficult level for yields to move above. And I know there's still a huge net spec short position in bonds. So there's a huge potential for a big short covering rally that sends yields sharply lower. So we just have to see what they do in the beginning of next week. Because again, one day is not a trend, but it is the start of something. Let's take a look. Andrew, don't you think they're going to raise 50 at the next FOMC? That's what the market is starting to discount in, but that changes really fast, with some new data. Personally, I don't know. I'm on the fence because they have so much in the pipeline. They still have 75 basis point hikes that aren't in the economy yet. So monetary policy has at least, a 6-month lag. So a lot of those 75 basis point rate hikes haven't even been felt. So we've already got kind of peak inflation. And once those hit the economy, it's going to accelerate more. So the Fed is trying to walk a fine line between killing inflation, but not making a horrible, horrible recession. At this point, I would say the probability of a recession is like 100%. And I expect it probably the second half of this year. So I think they're going to probably want to err on the side of caution now, just because they know they've got more rate hikes that are in the pipeline coming that haven't hit the economy yet. But the market's kind of, with a 50 basis point move in the 10-year yield over the last 2 weeks, the market's pretty much priced that scenario in. So if they don't, that could actually be a bullish thing for the market. Tony, is there any other money flow indicator that is somewhat similar to the one you use? I have TOS. Thanks, Brent. Tony, I've got a version of it for TOS. It's not exactly the same, but it's really darn close. So if you email me, I'll send it to you. But I guess the closest to it would be time segmented volume by Warden, which is one of their proprietary indicators. I know some people have made it for TOS, but it operates more of an oscillator, whereas 3C operates more as like a, it moves with price. It doesn't oscillate. Oscillators kind of range bound between 0 and 100. So this moves with price, and that was what I was trying to achieve with it. So some interesting really interesting stuff going on here with HYG. I mean, this signal alone would get me bullish. Let me take a look at the comments again. Algo psychology. Yep. I think I saw a recent chart of the semiconductors showing a large inverse head and shoulders. Could you have a quick look? As would imply quite an upward move. All right, let's take a look at the semis. I haven't looked at them that way. Give me just a second to pull them up. Actually, no, let me pull the chart up for you, and I'll show you how I do this. This isn't to say, this is the right way every way, but this is to say that bull flags are remarkably consistent in this parallelogram. So, I don't know. I mean, we can kind of go back and forth a little bit here as to what the correct interpretation is. And then watch this. I'm not even going to draw the other one. I'm just going to create a parallel line. And 9 times out of 10, I'll tell you that they are parallel, like perfectly parallel. And, you get little moves like this. This would be like a little bear trap. And then you get a rally up to the top of the thing. And then this would be like a little bull trap. You get a rally back to the bottom of the thing. So what I do see in semiconductors, and this is the SOX index, the Philly Semiconductor Index, is I see a bull flag, and with a conservative measurement, I'd say that's about 9.4, 9.5% measured move on a breakout above 3,100. So again, you can just measure that, or you can do what I showed before. So let's just take a trend line here and kind of roughly measure that. So wherever you get your breakout point, just add this little trend line to it. So yeah, 3,400 for the SOX. Let me take a look at what you asked about though. Let me clear off all these trend lines. And you said an inverse head and shoulders. Are you talking about like more recently, like right here? Let's see. Okay, so Adam may be looking at the SOX chart, 1 year chart. I mean, I've seen people recently arguing that some of these bull flags are inverse head and shoulders. The only reason, look, I'm not going to split hairs about it because I don't think it makes that big of a difference in the long run, because an inverse head and shoulders is a bullish consolidation too, and when you have a higher low, that's bullish. But the only reason I don't classify them as like an inverse head and shoulders is generally the word that's missing there is inverse head and shoulders base or head and shoulders top. So a base suggests that the preceding trend was down and it's basing. So like over here, I would say this is more like an inverse head and shoulders right here. Okay. Not after an uptrend, but again, it's kind of splitting hairs because the net effect is still the same. What I do like about the semis, let me take off the trend lines real quick. I'm going to pull up the tech sector. The semiconductors are what I call a sector with leading status. So they tend to be the more speculative or a little more high beta, and they tend to lead the broader sector. So you see NASDAQ, or I'm sorry, the tech sector right over here. And what I'm going to do is I'm going to add in the semis, and I'm going to normalize the price chart. So let's just put the SOX index here and make that blue so you can see it. Okay, so this is normalizing it right here. Start all plots at the same point. So wherever it starts here, they're normalized in percentage terms. And I'm going to take this out to, let's try to do like a year to date. Where's my little slider? Okay, there it is, year to date. So here we are, year to date, tech sector, semis leading to the upside. That's bullish. So you see the same thing. Dow transports tend to lead Dow industrials. So you'll see the same thing if you do that. The transports will be leading the Dow industrials, which is no big thing because Dow industrials have been doing nothing since the end of November. But so yes, I think this is a bullish thing. So I don't know. I probably wouldn't view a longer term. I know what some people are thinking about these being inverse head and shoulders bottoms. And if we look at stocks, I don't know if it's on there. So potentially, it's not my base case, but potentially. So what I was looking for, again, was a turn from down to sideways. So we do have that, and that's what I was looking for with this kind of phase one. Thank God the Fed is slowing down on rate hikes. Like if you look back, I don't think I have a chart with notations on it right now, but maybe next time I'll pull it up or I'll post it on the website for you guys. If you look back, I mean, all the way going back to like the 1929 crash, almost every bear market rally has started with some kind of catalyst of, well, the Fed didn't hike this time, or the Fed stopped hiking, or the Fed cut rates. Something with the Fed where the Fed came off as more dovish than what the market expected. And that's kind of what this whole thing has been about. So I don't know, you might get some FOMO, some people who've missed this whole rally that are starting to chase prices. And I've seen a little bit of that. We can see it in like sentiment indicators get frothy. But otherwise, my base case is, maybe we make a higher high. And if that happens, then yeah, there's going to be a lot of people reclassifying trends. But we haven't even hit the recession yet. So I'm having a hard time with that. Because, every Fed rate hike cycle, they break something. You never know where it's going to be. I mean, in 2007, 2008, you kind of knew where it was going to be with real estate, but something breaks down, dollar liquidity, whatever. So the cure to one thing is always like the problem that starts the next thing with the Fed. Let me take a look at the notes again. Or the chats. Thanks, guys, for these questions. Good questions, too. On gold. Okay, D. Frank, gold. So, and this is one of the reasons why, let me just make sure we're all looking at the same chart. Yeah, this is one of the reasons why I would have said, look, I think the S&P normally, if it had acted like it did any point last year, would be trading around 3,900 right now. Gold has an incredibly strong inverse correlation with the dollar and with yields right now, which means it tracks really similarly to the S&P 500, which is a little bit odd because gold is more of a safe haven asset, has not really acted as an inflation hedge at all, which has got a lot of the old time gold bugs from like the 70s and everything wondering, hey, what the hell's going on? Hope I don't get kicked off YouTube for saying that. Let me get to a daily chart and I'll show you where it starts. So you're looking at S&P 500 in the candlesticks, the red and green, and then GLD, the gold ETF in blue. Where does it start? Right here. The Fed starts hiking interest rates, right? And then all of a sudden, the dollar is a representation of what the market thinks the Fed's going to do. Yields, same thing. So the dollar and yields have been moving very closely together. And you start seeing, not a whole lot of correlation over here to a lot of correlation over here. And let me go to maybe like a 2-hour chart. It might be a little bit clearer. Come on, you. So, I mean, you can see they're kind of almost tracking together in trend. And if we look at this last couple of weeks, gold has acted a lot worse. And this is one of the things when I said to my subscribers that if this were any time last year with what's happened over the last 2 weeks, the S&P would be trading at 3,900 down here. Kind of where gold is relative on this chart. So gold has felt the pinch a lot more than stocks have of this whole hot economic data over the last 2 weeks since the payrolls, which was right here. Gold makes this big leg down. Don't like the price action. I'm just going to pull up GLD because it's easier for me to draw on this chart than TOS. But actually, I think I even have some trend lines. I don't like the price action. I so want to root for gold. I really do. And we did see kind of a base over here that looked a lot. I'm going to have to go to a longer chart. It looked a lot like the Dow's. It was same kind of W base here at the same time as the Dow and small caps. And we had this is a 1620 level, by the way, for gold futures. And we've had this really remarkable rally. The thing I haven't liked about this rally is that it hasn't done enough like stopping and consolidating. So just keeps building and building on. It's kind of like, if you imagine you're building a high rise, you have to have, if you want to build a high rise, you have to have a sturdier foundation. And as you move up each floor, you have to put in a sturdy floor or next level. If you don't do that, then the high rise is going to come tumbling down. It's the same thing with prices. Gold has just been kind of just creeping up, hasn't stopped and consolidated. That's bothered me, even though it's been very bullish. And then here's the breakdown. If we look a little bit closer over here, where I was telling you we have a bear flag. So we basically have about, and this pretty much applies pretty close for gold futures the same way. So about a 4.72%. And a lot of time, about midway between next leg measured move down, you'll get a small bear flag, which we kind of got over here. So if you say 4.72% or 4.7% or something like that, we still, where's that, about 165.44. Yeah, so we still have the potential of another 3.5% downside in gold. Now, the caveat to that is, if indeed yields just topped out Thursday night into Friday, gold's going to act a lot better. The dollar's been having a hard time at its 50-day moving average. I think it's just above it right now. But generally, yields and the dollar are going to move the same way. If they both come down, that's going to help gold a lot. Gold's got a big problem at 1900. Not a big fan. Let me see if I can pull it up real quick. The gold futures chart. I keep wanting to root for gold, and I keep seeing like, hey, this is starting to look good, and then it does something that just is like, okay, not this time. Just seeing if I have anything interesting on this gold chart. Yeah, okay, here's something interesting. I'm going to transition you guys over to TOS. Here we go. So this is gold futures, and that's 3C on a 2-hour chart. This is the base I was talking about at 1620 in October. Same as the Dow, double bottom or W bottom right here. And you can see what 3C is doing. It's positively diverging from this low to this low. It's making higher lows. It's making higher highs. It's leading gold price higher. We get over here above 1900, and what happens? The conviction starts to die off. Now, this isn't like a horrible divergence, like, oh man, this is distribution, get out, get out, get out. But what it is showing is that traders or investors don't have the same conviction that they had over here or over here. So, and then we negatively diverge right over here as it tries to kind of make this breakout up towards 2000, which was really the next key level it had to break through. So the first thing gold needs to do, if it gets a break from yields and dollar, is get back above 1900. We'll have to watch these 3C charts and see if they turn around, but you can see what the problem here is that traders don't have a lot of conviction above the 1900 level, and that's because it keeps losing it. So let me look at some other comments here. Oh, hey, V-Rent, you made it. There'll be a replay of this, so it takes YouTube probably like an hour or two to kind of render the video, and then if you go to my my channel and you hit the live button, you'll see it there as a replay. So remember, the market is closed on Monday for President's Day in the U.S. BTC futures on 3C. No, I don't use it that much on. Let's take a look and see if there's anything there. Well, that's kind of interesting. I don't know why this percent thing keeps coming up. That's kind of interesting. Actually, you know what? We did see a chart. I can't remember if it was the 15-minute, but look, when you see volume like this dump, you see this big dump, a lot of times that looks really bearish, but a lot of times that's short-term capitulation, like a selling climax. So yeah, it's kind of climbed up here and it's getting interesting. But for me, Bitcoin has to trade above 26,000 until I'm like really interested in it. And I know people could be like, well, you know, you're giving up 1,000 points. You could be giving up 15,000 points if it, you know, makes another move down towards the low end of its range. So I would rather it prove itself. Kind of the same thing with gold, with the 1900 level. But one of the observations I do have about Bitcoin is that it's a speculative asset, and typically towards the end of a bull market, or even like a good bull market or bear market rally, like if we want to consider this a bear market rally from the October lows, what you tend to see is towards the end of it, investors get into the more speculative stuff like Bitcoin or like these real high beta stocks. And that's another way you kind of know where you are in the process, or in kind of like the psychological stages of a rally. So the fact that I saw Bitcoin, or that we saw Bitcoin really make some of these moves, I don't know anything about the whole infrastructure and what's happening in the news and stuff, but for me, it just looks like, you know, we have a 4-month rally and you're starting to see some of the more speculative assets come into play. Let me take a look at the comments. Okay. BTC is manipulated. Yeah, I got to tell you though, there's a lot that's manipulated. Silver, gold. Matter of fact, you can look back, look up Blythe Masters. I think BLYTHE Masters worked for JP Morgan, and they got busted for manipulating silver prices for years. So, yeah, silver, gold, a lot of manipulation in those. And like I said, I have some older friends that were investors in the late 70s, and one of them is an economist. And I said, hey, you know, what is your take on why gold isn't acting better in an inflationary environment if it's in inflation hedge? He said, I have no idea. It's like one of the most puzzling things. I don't argue with it. I just look at what's happening, and what I see happening is a hugely strong inverse correlation with yields and with the dollar. And both those have been rising and have been putting pressure on gold the same way as the stock market. So let me see if there's any other comments here. Yep, that 1525K, that exactly, B rent. So I would rather it proved itself 1,000, you know, or 1,500 higher from here than sit in either dead money, which is that range, if you're willing to sit in a 10,000K, you know, price range. It's opportunity cost, it's open risk, and if the probabilities aren't there, I'd rather just keep my money safe or put it into something that's moving or working, or even, you know, a treasury or whatever. Unless the probabilities are there, I'm not a big fan of just speculating. How about 3C on natural gas? Oh gosh, natural gas has just gotten freaking hammered. I don't know. I haven't looked at it, so well, you know, maybe it's starting to get a little bit of a some buyers coming in because it has been so hammered. Let me show you real quick with UNG. UNG is just the natural gas ETF. I'm going to show you just because I know this program better, and I can do the whole measurement thing. So I'm transitioning over to UNG, natural gas. And I got to tell you guys something. When I see stuff like this, oh, let me get that trend line. This is an old trend line. Look at that. Didn't even know I had that there. Bear flag, by the way. And let me see if I can go out like 2 hours, 4 hours, something like that. Was that the top in, yeah. So kind of a toppy pattern over here. Let's see, that toppy pattern. I'm just guesstimating this for you guys real quick. 93%. Oh. Look at this bear flag over here to the far right. So 58% loss so far. This looks like a bear flag over here just from looking at that chart. Zoom in a little bit closer there. Take a closer look. Yeah, that looks like a bear flag right over here. And again, watch this parallel trend line. Probably coming pretty close. Pretty darn close. So if we're looking at it from that perspective, the toppy pattern says more to go on the downside. I'm not really quite sure where to measure this from. If I would take it from here, being conservative, which is 17.7%, or if I take it from here, which is 26.5%. But the price action doesn't look good at all. I'll say that. As far as the 3C chart, a lot of times, when you see a divergence like this, it can just be the start of a consolidation, like a bear flag. So it's something you just have to keep tracking and keeping an eye on. I would rather see some kind of, like, what would be constructive to me is if this were nullified, this bear flag were nullified and price blasted up through, for UNG, it's not the same for natural gas futures, but 825 and then moved up through 9. That to me would negate the near-term bearish price action. And then I would start getting interested in maybe trading natural gas on the long side. But what I was also going to say to you was when you see stuff like this, I'm not sure if USO is quite as bad. But no, it's not at all, really. But when you see stuff like this in a normal bullish environment, you see natural gas or you see crude oil take a 20% dive, and then you see like maybe the 10 or 30-year yield moving with them. These were all the things that were happening right before the COVID crash for like 5 weeks. I was pounding the table saying, stock market's making all-time new highs. You've got crude down like 20 some odd percent. You've got copper down. You've got the 30-year yield. They're all tracking in the same direction. Stocks are going in the opposite direction. Said major deflationary event coming. And then a couple weeks later, we had a 35% crash in the S&P over the whole COVID lockdown. But that's not what I see happening here. But just to answer your question about, how I would look at natural gas from UNG's perspective, just because I like drawing on this chart a little more. Okay, wonder whether next week should give it a pop. That could be. So you could draw this trend line on. I'm just no good with TOS. I just haven't spent the time to learn it. But and watch for a break above that bear flag. That would negate it. That would negate the second leg down. But other than that, this is still bearish price action. So. Okay, guys, I think we're going to wrap it up. So again, markets closed on Monday. For the new website, just give you a quick update. I've set up the server on Discord, which links to the website. So when you log into the website, you can just hit connect to Discord and go in there. It's for members only. And a couple of you have graciously volunteered to help me out testing that because I can only test it out with so many accounts. But that's up and running. A couple little minor things to do, and the new website will be up. So if you're a current subscriber to Wolf on Wall Street Trade, you are going to be grandfathered in at the current rate subscription, which is the same as it was from 2008. So you're beating inflation. Otherwise, for like new people that come in afterwards, it's going to go up a little bit just because everything's gone up for me, data feeds and all that. But good reason to subscribe now. If you're interested, check it out. Otherwise, I see you guys on Monday. Maybe you can hang on for a second. Let's just see if my little intro impresses you. Thanks, everybody. Really, really appreciate you joining me. Have a great weekend.